Our next guest calls the Archegos implosion a wake-up call for the bank. Sheila Bair is former FDIC chair. She is now the director of the Volcker Alliance. Sheila, great to have you back. Welcome.
Thanks for having me.
So does this say to you that the U.S. banking system is terrific in risk management, is terrific in terms of the capital that they have stored up since the financial crisis, or does it still tell you that we've got a problem?
Well, I think it says we've got a problem. I mean, there was a lot of risk building up in the system, a lot of exposure. Maybe they dodged the bullet, but there were some people apparently on the other side of some of their sales that did not dodge the bullet. Did they have good risk management? It suggests to me they didn't to let this happen to begin with. And maybe they just had better information and were acting more quickly. In terms of dodging the bullet, whether they acted ethically in this, I don't know. Whether they acted legally, I don't know. I think there's going to be a lot more questions about how they handled this situation. But the fact that they even came this close, I think, suggests that, that their risk management leaves a lot to be desired. I will say, in fairness, though, that market conditions and, this forever lasting zero interest rate policies, this is just another indication of how leverage is building up in the system. Capital costs virtually nothing. They can make a lot of money over these arrangements they do with these private offices and hedge funds. It's capital light activity. And so they're building the bombs. Even if when the bombs go off, they aren't hurt. They're still helping to build the bombs. And is that really appropriate for regulated holding company banking organizations? Is that appropriate? Is that safe and sound behavior? I'm hoping this triggers at least some supervisory review. But also, the market conditions are there. The Fed really needs to step up and tighten supervision, knowing that the monetary policies that is pursued for so long is creating incentives for exactly this kind of behavior.
Sheila, it's Karen. Thanks so much for coming on the show. We always love hearing what your thoughts are. So here's my question. I think it is possible that the banks didn't fully understand the risk they had because there wasn't adequate disclosure by Archegos. And that shouldn't there be regulation as well? They might not have realized, wow, we got $5 billion risk of Viacom or whatever it is. Isn't there a duty there also? How would you address that?
Well, to be honest with you, I'm skeptical about whether they didn't really know that Archegos was building these positions with multiple prime brokers. Let's give them the benefit of the doubt and say that they did not know. They should have known. There should have been disclosure around this. This is one of the areas where our disclosure requirements have not kept pace with the ability to create synthetic positions that can have market-moving impact concentrated in one market participant. But because it's a synthetic position as opposed to actually owning the security with some voting power, the disclosure rules just don't kick in. So this has been a problem for a long time. It absolutely underscores it needs to be fixed, not just so these prime brokers know about each other's activities, but the investors generally know that there are particular market participants who are building up these huge concentrated positions of particular stocks.
Hey, Sheila, it's Tim. Thanks for your insights. Great, especially tonight. And I want to get at the point I think you're making towards the tail end of your first statement around the Fed's role in all this. Banks report in a week and a half. Next week, we're going to be talking about the numbers. A primary issue will be capital return. It will be how aggressive they can be on buybacks and dividends. What's the Fed's role here? And should investors going into that be concerned about the Fed maybe being a little bit more difficult than just a June 30 all green light?
Well, I hope that they will, at least their supervisors, they may not be doing more regulation. I hope they do. I think there's some areas that they could improve. But at least from a supervisory perspective, there's going to be much more intensive scrutiny of the prime broker operations and particularly their relationship with hedge funds. So I think bank investors can and should expect that. Whether they'll hit returns, maybe. I don't know to what extent that the Fed may tighten its supervisory scrutiny. But I will say, I think it's somewhat ironic. Look, we've seen large financial institutions, banks that are in the safety net, that have affiliates with deposit insurance, that have access to the Fed. They have been pulling back on Main Street lending, right? They've been tightening lending. They've been pulling back in mortgage lending, tightening standards for Main Street for loans, right? Loans are capital intensive, and the returns are not so great right now. So they've been pulling back in favor of this capital light activity, which is frankly riskier. And I think maybe there's a silver lining on this, is that they're getting their fingers singed a bit, catering to these super rich clients when they've been pulling back on Main Street. But here again, the Fed needs to look, and all the bank regulators need to look at the kinds of incentives that are being created by the capital requirements as currently structured, the failure to tighten margin requirements on these kinds of, high risk derivatives transactions, and whether we are expecting enough of our banks to do Main Street lending when the country needs them, especially when they're still doing buybacks and dividends, and those have started up again. So that's a longer answer to your question, but yeah, short term, yeah, I think the Fed's going to be tightening up. I think that's a good thing, but longer term, really, is this how, banks are in the safety net? You're outside the safety net, go do what you want, do as many stupid things as you want. But if you've got this kind of federal safety net support, I think there are some social obligations that go with this. And to be doing this kind of behavior when they're pulling back on Main Street, I think is really something regulators and policymakers should be thinking about.
Yeah, it's interesting. And you said, started the show by saying maybe Goldman and Morgan Stanley dodged a bullet. Maybe the system dodged a bullet. But, I think you would agree there are probably other situations out there we're just not aware of. My question to you is, and I have to preface this by saying I am no fan of our Federal Reserve of central banks. I think it's important to say that. Otherwise, the question seems different. How much of the brunt of the responsibility does 12 years of zero interest rate policy have to do with some of the behavior that we're seeing here?
Well, I think banks should always be held accountable for their actions. They need to look, you're this big, you're this systemic, you need strong risk management. You need to deal with the risk presented by the market that you operate in. That said, yeah, it's created a lot more challenges to manage risk. Again, when capital is so cheap, when the incentives to lever up are so strong, when you can make so much money by doing exactly the kinds of transactions that Goldman Sachs and Morgan Stanley were doing, these are the incentives that ZIRP has created. And I do think if the Fed's going to continue these policies, and clearly they are for the foreseeable future, at least tighten up on the supervisory and regulatory side to try to address some of these risks. Just increasing margin requirements, just make it a little more expensive through margin to borrow would help. But I'm not sure the Fed's thinking in those terms, but I hope they do start thinking in those terms.
Along those lines, Sheila, I wanted to follow up on a metaphor that you used, and that is they helped build the bombs, and maybe this time the bombs didn't hurt anybody, but they still helped to build them. That implies that at some point the bombs will hurt somebody. Is that somebody?
I think that's
is that somebody? The system?
Well, I think it's so. I think there were people that owned stock, Viacom and others. Their share price took a hit. So I think it wasn't like there was no systemic consequence, but there were people who were, collateral damage in all of this. But I do think this, as I said earlier, this kind of business that they're doing, this is not a one-off. I think they're doing a lot of this kind of business with hedge funds and these private offices that are essentially hedge funds. So, yeah, I think we could see a lot more of this. Whether it happens in tandem, I don't know. The lack of transparency makes it difficult for all of us to truly assess what the risks are. But, again, prioritizing, I'd increase margin requirements. I would tighten supervision. I would absolutely fix this loophole we have in our SEC disclosure rules, where if you build up a concentrated position through synthetically through a derivative, you don't have to report. That everybody needs to know that. And so those are things that are short-term fixes I think could help a lot. But yeah, I think the system is at risk. And the sad truth is we don't really know because there's really no transparency around this kind of business.
Sheila, thank you very much. Always great to hear from you.
Pleasure.
Sheila Bair, former FDIC Chair. Dan Nathan, it sounds like, if half the things Sheila said were enacted for the banks, that's not necessarily great for business.
Well, listen, you could ask, is this the sort of business the banks wanted to be doing? And if there was more disclosures, they probably wouldn't be doing that sort of business to that extent. And, we've been asking this question for the last couple of weeks. What sort of activity with total return swaps could be systemic? And obviously it seems pretty isolated to this situation. She also used a really interesting term, whether the way that Morgan or Goldman acted were ethical. I don't know if she was speaking specifically to those, but they obviously ran ahead of some of their counterparts once that they had news news of what was going on once it seems like Credit Suisse or Nomura brought that to the fore. And not only did they run ahead their competitors that gave them the information, but they also plugged their clients. If you go look at Baidu, where it closed on March 25th, it closed at $204. The next day it traded as low as $174, and that means that everyone else was out there selling it, including the hedge funds that probably got plugged on that print on Thursday the 25th. So to me, this is also a business not just about printing tickets, because that's what the guys who lost a lot of money were really focused on, but it's also about trust with your clients, and I suspect Goldman and Morgan might have done some damage on that front. Last thing I'll just say on this is that if you look at Credit Suisse's disclosure for Q1, they say that they're going to lose $1 billion in the quarter, and they told you that they lost 4.7 on this trade. That tells you that there's a lot of good things going on in the banking system right now where they're really profitable and they can absorb those sorts of hits on a quarterly basis.
Maybe that's the takeaway. Everything was fantastic for Credit Suisse's business up until Greensill and this. Oh, yeah, Greensill also happened to Credit Suisse just within weeks of Archegos imploding. Karen, how do you think about maybe the reputational damage to the banks or the possibility of a tighter regulatory environment on the back of this?
Well, just to go back to your first question we asked Guy, are you proud of Morgan Stanley or upset that they were in this? Yes to both, right? And I think also Dan made some great points about, wow, how profitable must they have been to be able to weather this gigantic hit as well as they did and only be down whatever 900 and whatever it is. So I think we're going to see some great bank earnings, although the stocks have already moved. I also think it takes time to do regulation of the sort that might need to be done here to prevent this. And without the U.S. banks having really been sort of seared by this, I don't know how much, I know Elizabeth Warren is upset about it, but I don't know how much it'll take to actually enact any of those potential regulations. But I also think Sheila's point about the SEC needing to really work on the disclosure issues is really important as well, because she made the point, not just disclosure for the banks, but disclosure for shareholders. I mean, they enjoyed the ride-up, maybe in Viacom. I didn't. I left way too early. Maybe that leaves me a little bitter. I don't know. But I think it's important to know who's got what, and that would have been important for these banks to know, because I can't imagine they knew the full extent of the exposure that they had. Now, some of that's on them. And then the last thing, I'm wondering if the people who they stuffed the trades to were all the SPAC buyers who made a fortune, and this is a little bit of payback. I don't know. Could be. All that having been said, I'm long banks going into next week when they start reporting.
Yeah.
Shepard Smith here. Thanks for watching CNBC on YouTube.